Hello everyone, I am Ankit Soni, Fundamental Analyst at Mire Asset Sherkhan, and we welcome to our annual market review and way forward series. As we look back at 2025, the Indian equity markets tell a story of resilience, recalibration, and consolidation. It was a year that tested patience, challenge, momentum driven narratives, and yet quietly reinforced the strength of India's long term economic foundation. Let's take a closer look at what really defined Indian equities in 2025, themed as a year of domestic resilience. Market performance. A challenging year 2025. The market has turned out to be a stormy year for Indian equities. The markets delivered single digit returns, significantly underperforming global peers and even several emerging markets, making India an unexpected underperformer during the year. Despite supportive domestic factors, this gap in performance stood out sharply for investors. While strong GDP data, RBI rate cuts, and stabilizing corporate earnings helped indices touch 52 weeks high, the rally struggled to sustain itself. Persistent foreign institutional investor outflows and a weak rupee emerged as a major headwinds, limiting upside momentum. A snapshot of FII versus DII. DII remained as a backbone of stability. One of the most defining features of 2025 was the prolonged FII exodus, which has now continued for nearly 1.5 years. However, what prevented a deeper market correction was a steady and a strong participation of domestic institutional investors. DII flows absorbed much of the selling pressure, acting as a crucial stabilizing force for the markets. DIIs bought in around 6 lakh crores for current year. This shift clearly highlighted the growing maturity and depth of India's domestic capital base. Divergence across markets. 2025 also witnessed an extreme divergence in the market performance. When we see Nifty managed to hold on at gains of around 5%, the Nifty small cap index corrected sharply, nearby around 10%. This reset was largely driven by stretched valuations in the smaller segments, particularly in movement-driven pockets. So what we see is it's a healthy pause in a long-term upcycle. Importantly, this correction should not be mistaken for a breakdown. Instead, it represents a pause within India's multi-year economic upcycle. From a market health perspective, consolidation after strong multi-year gains is both normal and constructive. This phase allows earnings to catch up with the prices and helps improve the overall risk-reward equation for long-term investors. What would be the key triggers to watch ahead? Looking forward, the markets are closely tracking a few important triggers. Globally, the India-US trade deal remains a key variable, with an earlier solution likely to be beneficial for the sentiment. Domestically, the focus is firmly on macroeconomic trends, translating into an earnings rebound, which could lead to double-digit profitability growth. Encouraging the earnings downgrade cycle appears to have stabilized, setting the stage for a stronger second half. A few sectoral trends where trends are emerging. On a sectoral basis, several pockets are showing improving visibility. So when we see financial sector is positioned for a healthier second half of financial year 26, supported by strong credit momentum with banking credit growth at around 11.4%, which came in around mid-November 2025. While RBI rate cuts may create near-term NIM pressure for banks, they are structurally positive for NBFCs by lowering borrowing costs. IT sector is at an inflection point with early momentum in AI-led deals and margins holding up well. Valuation remains attractive, making the sector an appealing long-term opportunity. FMCG sector is expected to see sequential volume recovery driven by festive spillovers, healthy monsoons and delayed demand from GST rate cuts. Now coming to real estate sector. Sector enters a launch heavy phase in second half with rate cuts likely to further support demand. Coming down to metals, metals stand out structurally benefiting from the EVs, renewable energy and data centers, all of which require a significantly higher metal intensity. Government focus on self-reliance in critical minerals further strengthens the outlook. The closing perspective. What 2025 truly taught us? To sum it up, 2025 was a year of consolidation and cooling, especially in the small cap space, but it also reinforced the fundamental strength of Indian economy. Valuations today are around 20% cheaper when compared to 2025, and setup for H2 financial year 26 and financial year 27 looks materially stronger with an earnings accretion cycle potentially beginning, stable macros and sustained domestic inflows. Indian equities offer a far more attractive risk reward going forward. As we wrap up, the key stock calls and recommendations from our research team will be displayed on your screen for your reference. While caution remains warranted in small and micro caps, large cap stocks are likely to stay in favor, positioning the market constructively for a foreseeable future. Thank you for watching, and as always, happy investing. Thank you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.